am Dr.S.Kartheeswari, Assistant Professor of Commerce, Department of Commerce, CASF, SFR College for Women, Sivagasi. In this class, we have to discuss about cost and management accounting under the paper title of 23 PKCSE 41 Training for Competitive Exam. In this slide, we have to learn about explain the objective of cost and management accounting and outline the importance of cost and management accounting and what are the differences between cost and management accounting and identify the applications of management accounting in this slide. Next we have to see about what is cost. So cost means how much amount we have to spend for producing the product. According to Institute of Cost and Works Accountant, cost means determining the amount of expenditure incurred on both attributes of accounting emerging cost accounting. Okay, that is, it simply means that how much amount we have to spend for producing the product. Next we have to see about costing. Costing is a technique and process of ascertaining the cost, and it is the both calculation of products as well as services also. Costing is a systematic procedure of determining the unit of cost of product or services. The process of cost accounting begins with the recording of income and expenditure and ends with the preparation of periodical statements and report for ascertaining and controlling the cost. So cost accounting is nothing but it is a process of accounting for cost begins as well as the recording of income and expenditure ending with the preparation of periodical statements and reports for ascertaining the cost as well as control and cost reduction. Next we have to see about what are the main objectives of cost accounting. So the following are the main objectives of cost accounting. First one is analysis and ascertainment of cost. The primary object of costing is to ascertain the cost of each product, process, department, service or operation. It includes prime cost, works cost, production cost, cost of goods sold, etc. The second main object of cost accounting is presentation of cost for cost control as well as cost reduction. In order to cost control and cost reduction, we have to compare the actual with the standard, then only we have to take necessary corrective action for future. Next, the third main object of cost accounting is planning and decision making. Costing helps to make decision making like pricing of the products, introduction of new product, machinery, shutdown decisions, wages, expansion plan, choices of amongst various alternatives, etc. So cost accounting helps to make decision making. Next we have to see about importance of cost accounting. The following are the importance of cost accounting is provide reliable cost data with regard to both material, labor, direct expenses as well as indirect expenses also. It helps in the price fixation, that is how much amount we have to spend for producing the product. It provides information on which estimates and tenders are based. Next, it helps in channelizing productive resources. It guides future production policies and helps in planning. It helps in determining profitable and unprofitable activities. Cost accounting increases efficiency and reduces wastages and cost. It provides cost data and useful comparison in different periods, and it helps in inventory control also. It is useful tool for managerial control, that is cost control and cost reduction. Next we have to discuss about what are all the advantages of cost accounting. Cost accounting is mainly helpful to three persons. First one is management, second one is employees, then third one is creditors, investors and bankers. So how it's helpful to the management is to carrying out the functions, that is planning, organizing, staffing, directing and controlling. So these management functions are effectively controlled through the cost accounting procedures. Then how it's helpful to the employees means cost accounting is mainly helpful for cost control and cost reduction. So the cost of the product is coming down, so it is very helpful to the employees because the cost, that is wages is increased, and incentive and bonus plans are increased to the benefit of employees. Then how it will helpful to the creditors, investors and bankers. It enables creditors, bankers and investors to judge the financial position and solvency position of the concern with the help of published financial statements. So it is helpful to them to make investment and loan purpose. Then how it's helpful to the government and society. Cost accounting increases the efficiency of a concern, reduces cost and profit. So it promotes an increased profit, so it promotes overall economic development of the country. So it is helpful to the government. Next we have to discuss about what are all the limitations of cost accounting. It is not an independent system of accounts. It is an estimates like absorption of indirect expenses, apportionment of expenses on estimate basis only. So it is a scope for subjectivity on items like depreciation, valuation of closing stock, goodwill, etc. is to be absorbed. So it is very ambiguous in the calculation. Then it does not take into consideration of all items and expenses and income like interest, goodwill written off, taxes paid, provision for bad debts, discount and loss on issue of shares and debentures are not taken into the cost accounting. So it is also a main limitations of cost accounting. Next we have to go for management accounting. So in order to overcome the limitations of cost accounting, we have to go for management accounting. So what is management accounting? It is a system of accounting concerned with the internal reporting or information to the management for all the management functions from planning to controlling. It involves collecting, classifying, analyzing, interpreting and presenting all accounting information which are useful to the management. According to Institute of Cost and Works Accountant of India defines management accounting as a system of collection and presentation of relevant economic information related to enterprise for planning, controlling and decision making. Next we have to see about what are all the characteristics of management accounting. The following are the characteristics. First one is providing adequate accounting information. So it is helpful to the management according to decision making. Then second characteristic is taking corrective actions. So we have to find out the deviations between actual and standards with the help of preparing budgetary control and standard costing. So we have to take corrective action on the correct time. So it is very helpful. Then third characteristic is use of special techniques and concepts. So it is that major techniques used include financial planning, analysis, standard costing, budgetary control, marginal costing, standard costing. So these are all the tools we have to apply for controlling the cost and reduction and interpreting the decision purpose also. Then taking important decisions. Management accounting helps in taking various important decisions like we have to make or buy decision, accepting the foreign order or not. So these helpful to take important decision on a correct time. No fixed norms followed. In management accounting, no specific rules are followed to maintain it. According to their requirements, we have to prepare themselves. Then increase in efficiency. The performance appraisal will enable the management to pinpoint efficient and inefficient spots, and it is concerned with forecasting. The management accounting is concerned with the future, which help of preparing the budgetary control for planning and forecasting. And internal use. The information provided by the management accounting is only exclusively used for internal purposes also, that is decision making only. Next we have to go for scope of management accounting. So first one is financial accounting. The recorded facts about an organization are used for planning the future course of action. Financial accounting deals with only historical data. So such planning is very helpful to management accounting for taking the decisions. Then second, cost accounting. It provides various techniques for ascertaining the cost of manufacturing the products and services. Then third one is financial management. It is concerned with the planning and controlling of financial resources of the firm. It deals with raising of funds and their effective utilization. So in management accounting, we have to prepare cash flow statement and fund flow statement for making use of income from operations. Then we have to prepare budgeting and forecasting. So it means expressing the business plans, policies and goals of the enterprise for defining the future period. So the targets are setting for different departments and responsibility is fixed for achieving these targets. Forecasting is a prediction of what will happen as a result of a given set of circumstances. So budgeting and forecasting are useful for management accounting in order to take good decision. Then inventory control. The control of inventory will help in controlling the cost of products and services. So the management accountant will guide the management to when and from where to purchase and how much to purchase. So the study of inventory control is very essential to control the inventory. Then reporting to management, the reports are presented in the form of graph, diagrams, index numbers and other statistical techniques in order to prepare the financial reports and published by the newspaper through auditor adjusted statements only. The reports may be monthly, quarterly and half yearly. These reports cover profit and loss account, cash and fund flow statement and balance sheet. These statements should be audited by the auditor. Afterwards, it should be published in the newspaper. Then interpretation of data. The management accountant interprets various financial statements to the management and gives an idea about the financial and earning position of the concern. Control procedures and methods. It is needed to use various factors of production in a most economical way. An internal audit system is necessary to judge the performance of every department. So internal audit helps them in fixing the responsibility on different individuals. A management information system. In a large scale organization, information is preserved and supplied to the management with the help of computers. So information which is usually recorded and supplied by the accountant mainly is processed and communicated with the help of computers. Next we have to see about objectives or functions of management accounting. The first main function of management accounting is planning and forecasting. It is an important function. So we have to prepare budgeting with the help of planning each and every activity according to the amount required to complete the task. So it helpful to them for comparing the deviation between budget as well as actuals. So they had prepared fund flow statement, profitability ratios, trend ratios for fixing the target. So many techniques are used for such various activities. Then modification of data. The management accountant classifies and modifies information according to their requirements. Financial analysis and interpretation. Management accounting is mainly helpful for interpreting the data. From this interpretation, we have to find out the financial position, solvency position like this. Then facilitates managerial control. The actual performance is recorded and deviations are also calculated. It enables the management to access the performance of everyone in the organization and facilitates effective management control. Communication. Management accounting establishes communication within and outside the organization. That is, they are preparing the reports and publish it in the prescribed newspapers. So it is helpful to the stakeholders, then government agencies, bankers for making their fund investment and loan purposes. Then use of qualitative information. Management accounting provides both qualitative and quantitative informations. Next, coordinating. The management accountant acts as a coordinator among different financial departments from the top of budgeting to last task of preparing the reports, financial reports. Then helpful in taking strategic decision. Management accounting supplies analytical information regarding various alternatives and the choice of management is made easy. So the decisions may be regarding stoppage of production, replacement decisions, expansion or diversification of works, incentive or bonus raised. So it is very helpful. And supplying information to various levels of management. The management accountant feeds the information to different levels of management so that further decisions are taken. The supply of adequate information at the proper time will increase the efficiency of management and helpful in organization and tax administration. Each and every management is concerned with the establishment of cost center, preparation of budgets, cost accounts and fixing the responsibilities of different functions. Cost center is nothing but production, then accounting, finance, separate sections are there. Then helpful in tax administration means we are assessing various tax liabilities and depositing to correct amount taxes with the concerned authorities with the help of preparing the financial reports like audited financial statements, balance sheet and profit and loss account. Next we have to see about what are all the advantages of management accounting. It measures the efficiency and proper planning through budgetary control and measurement performance with the help of preparing standard costing. That is, we have to prepare, find out the variations or deviations. We have to get the positive deviations or negative deviations. Positive deviations means actual is more than that of expectations. Expectation is less than that of actual, then we have to get the positive deviation. Suppose budgetary control, that is with the help of budgetary control, expectation is more than that of actual, then we have to get a negative deviation. So we have not continued such deviation, so we have to rectify it. Then maximizing profitability. So with the help of preparing ratio analysis, we have to find out the GP ratio, net profit ratio, we have to find out the profitability portion of the concern, whether it is going on a good manner or fluctuating like that. Then improve service to the customers also, effective management control and decision making, facilitates communication. So these are very helpful to the public. Then what are all the limitations of management accounting? Here we have to discuss about what are all the limitations of management accounting. First one is based on accounting information. So it is not an accurate one. Then second one is lack of knowledge. That is, we have not followed a systematic procedure or universal procedure. So it does not have adequate knowledge about principles of management, accounting principles, statistics, that packages. Then initiative decisions, not an alternative to administration, and high cost. So these are all the limitations and of management accounting. Next we have to go for management accounting applications. How management accounting applied in various levels or various chapters. So management accounting is applied in the following areas. First one is financial statement analysis. Financial statement analysis is also known as analysis and interpretation of financial statements. It refers to the process of determining the financial strength and weakness of the business firm by preparing the profit and loss account and balance sheet. So with the help of this, we have to compare these financial statements through comparative income statement and a comparative balance sheet. The purpose of financial analysis is to diagnose the information contained in financial statement so as to judge the profitability and financial soundness of the firm. What are all the objectives of preparing financial statement analysis? So the following objects of financial statement analysis. First one is to estimate the earning capacity of the firm, to estimate the financial position and the financial performance of your firm, to determine the long-term liquidity as well as solvency position, debt capacity of the business, and decide about the future prospects of the firm also. Why financial statement analysis prepared? What are all the tools, utility, usage? Okay. So the first one is to a prospective shareholder, to a prospective investor, to a prospective supplier, and to the management. So these four persons used financial statement analysis for their purposes. Next we have to discuss about types of financial statement analysis. So financial statement analysis can be bifurcated. First one is external analysis and internal analysis. So external analysis is done by the outsiders But these persons who do not have any access to the detailed internal accounting records of a business firm. Outsiders means investors, creditors, government agencies, credit agencies and general public, they are analyzing the statements. And second type is internal analysis. It is conducted by a persons who have access to the internal accounting records. That is those who are working in a top executive of a business firm. They are studying the financial reports submitted by the management committees and analyzed that. Then according to modus operandi, it can be also bifurcated. So the first one is horizontal analysis. It is also called it as dynamic analysis. It refers to the comparison of financial data of a company for several years. So the figures of this type of analysis are presented horizontally over a number of columns. A base year is chosen from the beginning point, that is the first year is the basic year. Then vertical analysis, it refers to the study of the relationship of the various items in the financial statements one accounting period. The example of horizontal analysis is comparative income statement and comparative balance sheet and trend percentages. Vertical analysis example is common size income statement and common size balance sheet. Next we have to go for comparative statements. So what do you mean by comparative statements? Comparative financial statements which show the financial position of a firm in different periods of a time. That is, we have to find out the financial position of the business for current year and previous year. So for these comparative statements, we have to prepare two statements. First one is comparative income statement and another one is comparative balance sheet. Comparative income statement gives an idea about the progress of a business over a period of time. The changes in absolute data in money values and percentages can be determined to analyze the profitability of the business. That is, the format of comparative income statement is details, current year, previous year, current year, increase or decrease in amount and percentage of increase or decrease according to the current year and previous year. Then the next statement is comparative balance sheet. The comparative balance sheet analysis the study of the trend of the same items, group of items and computer items in two or more balance sheet of the same business enterprise on different dates. The changes in periodic balance sheet items reflect the conduct of a business. So the changes is observed by the top management through the preparation of comparative balance sheet. So similar format is followed, that is the details to previous year, current year, increase or decrease and percentage of increase or decrease. Next we have to go for trend analysis. So trend analysis is helpful in making a comparative study of the financial statement on several years. But comparative income and comparative balance sheet we have to compare with current year and previous year only. But trend analysis we have to compare the same statement for several years. Here first year is taken as a base year. For example, we have to analyze the financial position of the company from 2020 to 2024. 2020 is the base year. So and 2024 is the current year. So how much will change, go up or increase or decrease? So 2020 I take it as a base year. Next we have to prepare common size statements. Common size statement, here also we have to prepare common size income statement and common size balance sheet. Common size income statement can be shown as a percentage of sales to show the relation of each item to the sales. Here total sales is taken as a 100 and common size balance sheet total assets and total liabilities is taken as a 100 for a percentage purpose. Next we have to go for ratio analysis. This is more important in the management accounting tool because it is highly indicator of financial position, profitability position and debt position, solvency position, equity, like that. So it is a very powerful tool. So ratio, first what do you mean by ratio? A ratio is a simple arithmetical expression of the relationship of one number to another. It is expressed in percentage or times like that according to its constraints. It is very helpful for decision making purpose. So what are all the classification of ratios? So first one is liquidity ratio, then long term solvency ratio, activity ratio and profitability ratio. So first we have to go for the classification on the basis of liquidity ratio. So liquidity ratio, liquidity means to meet the emergencies, okay. So to meet the emergencies like the concern, the ability of the concern is to meet its current obligations as end when they arise. The short term obligations are met by realizing amounts from current floating or circulating assets. So liquidity ratio means to measure the liquidity position, cash and cash equivalent position. It is good, your position is also good, your company's position is good. So what are all the ratios to calculate liquidity position? First one is current ratio. Current ratio means it studies the relationship between current assets and current liabilities. Standard ratio is 2:1. Current assets means cash in hand, cash at bank, sundry debtors, short-term marketable securities, prepaid expenses, closing stock, outstanding income, bills receivable and short-term investment. Current liabilities are the liabilities which are converted or paid in cash within a 1 year. So what are all the current liabilities? Sundry creditors, bills payable, outstanding expenses, provision for taxation, bank OD, dividend payable, income received in advance. So these are all the current assets and current liabilities. We have to find out the relationship between these two items, find the current ratio. So current ratio standard is 2:1. So current assets is higher than that of current liability, your position is good. Then next go for liquidity ratio or quick ratio or acid test ratio. It is studies the relationship between liquid assets and current liabilities. Its standard ratio is 1:1. So what do you mean by liquid assets? That is current assets minus stock and prepaid expenses. So we have to omit stock and prepaid expenses because stock is not easily converted into cash and within a 1 year. So it is not coming under a liquid asset. So what are all the liquid assets? Cash in hand, cash at bank, sundry debtor, short term marketable securities, outstanding income, bills receivable. So you have to omit just stock and prepaid expenses for liquid assets. Then current liabilities as usual, creditors, bills payable, outstanding expenses, provision for taxation, dividend payable, income received in advance, bank overdraft, etc. So the standard ratio for quick ratio or acid test ratio is 1:1. Then next one is absolute liquid ratio. Absolute liquid ratio standard ratio is 0.5:1. So it studies the relationship between cash, bank and marketable securities only and current liabilities. That is current liabilities as the same, but in current assets you have to omit stock, prepaid expenses, bills receivable, debtors, outstanding income like that. Just we have to ready cash, that is to be taken as the absolute liquid assets, that is cash, bank and marketable securities. So it studies the relationship between the cash, bank, marketable securities and current liabilities. The standard ratio is 0.5:1. Next classification is solvency ratio. So here the following ratios prepared by the management accountants to find out the solvency position of the business. So the first position is ratio is debt equity ratio. So what do you mean by debt equity ratio? It expresses the relationship between external equities and internal equities. So external equity means outside equity. Internal equity means owner's fund. Okay. So it studies the relationship between external equities and internal equities. External equity means current liabilities plus long-term liabilities. Then internal equity means proprietor's fund only. Proprietor's fund means equity capital, then preference share capital, reserves and surplus. These three only coming under proprietor's shareholders fund. Proprietor's fund or shareholders fund. Second ratio is proprietary ratio. It is also called it as equity ratio. It studies the relationship between proprietor's fund and total tangible assets. Already we had calculated proprietor's fund, that is equity share capital plus reserves and surplus plus then reserves and surplus plus preference share capital. Okay. Then total tangible assets means all the tangible assets only included. Goodwill, அதெல்லாம் என்ன பண்ணக்கூடாது அப்படின்னா எடுக்கக்கூடாது. Goodwill, fictitious asset, then amortization. So these items excluded from the assets. Only tangible assets, land and building, plant and machinery, data, stock. So these only covered under total tangible assets. So the interpretation of proprietary ratio is relationship of owner's fund to total assets. Higher the ratio, better the long-term solvency position of the company. That is, proprietary ratio is higher, your position is good. Then next one is interest coverage ratio. Interest coverage ratio, it is used to test the debt serving capacity of a firm. It is also known as debt serving ratio or fixed charges cover or times interest earned. So it studies the relationship between net profit before interest and taxes and fixed interest charges. Fixed assets to net worth ratio. It studies the relationship between fixed assets, but you have to take after depreciation, that is land and building, then you have to deduct the depreciated value, and as well as plant and machinery also you have to deduct depreciation. That value is to be taken, and it studies the relationship between that value from the proprietor's fund. Already we had calculated proprietor fund, that is equity share capital plus preference share capital plus reserves and surplus. So the desirable ratio is 1:1. Okay. The next one is capital gearing ratio. It studies the relationship between preference capital, long-term debt bearing fixed interest charges, and equity capital plus reserves and surplus. The standard position is high gearing ratio, that is means preference capital is more than that of equity capital, so it's very drawback to the equity holders, owners of the business. So we have to concentrate both the structure, that is preference capital, equity capital. Equity capital is more than that of preference capital, the position is good. Usually 0.75 or at least 0.5:1 is desirable. Okay. Then next we have to classify on the ratio on the basis of activity ratio. It is also called it as turnover ratio. Here we have to compare the sales. So it studies the relationship between sales as well as cost of goods sold, like that. So the first one is inventory turnover ratio. It is also called it as stock turnover ratio. It studies the relationship between cost of goods sold and average stock. Cost of goods sold means opening stock, add purchase, less closing stock, plus direct expenses, that is wages, direct material, direct expenses, all are included. Another formula for calculating cost of goods sold is sales minus gross profit. So from these two aspects you have to calculate cost of goods sold. Average stock means opening stock plus closing stock divided by 2. So it studies the relationship between cost of goods sold and average stock. So the interpretation of stock turnover ratio indicates high inventory turnover ratio indicates brisk sales. Low inventory turnover ratio implies that over investment in inventory. That is sales is better than that of cost of goods sold. You have not so many amount as inventory. It affects your working capital position. So high inventory turnover ratio indicates the brisk sales. So high turnover ratio is good. Then second one is debtors or receivable turnover ratio. It studies the relationship between net credit annual sales and average trade debtors. Two kind of ratios can be computed to evaluate the quality of debtors. The first one is debtors velocity, that is studies the relationship between Net credit annual sales. Here we have to omit the cash sales. So just credit sales only taken at, that is the debtor. So we have to take the net credit sales, that is sales less sales return, that is the net credit sales. And average trade debtors means opening debtors plus closing debtors divided by 2. So the interpretation is higher the value of debtors turnover, the more efficient in the management. Suppose the lower, then you have to concentrate more on collection of debt. It is a warning signal to you. Okay. Then average collection period. How would you calculate average collection period? It calculated as follows: debtors plus bills receivable divided by net credit sales into number of working days in a year. The interpretation of average collection period is the better is the quality of debtors, as a short collection period implies quick payment by debtors. You have not give more days to collect the debt. Next we have to go for creditors or payable turnover ratio. It is also called it as creditors velocity. It discusses the relationship between net credit purchases and average trade creditors. Here we have to omit the cash purchases, only credit purchases included. Net credit purchases means credit purchases less purchase returns, that's the net credit purchases. Average trade creditors means as usual opening creditors plus closing creditors divided by 2. Then higher creditors velocity is better, it is otherwise lower the creditors velocity less favorable. So higher creditors velocity is better for your position. Then average payment period means creditors plus bills payable divided by net credit purchases into number of days in a year. Average payment period ratio represents the average number of days taken by the firm to pay its creditors. Generally lower the ratio is better, that is you have to quickly settle your creditor, your position is good. Suppose you have to take more number of days to settle the debt, then your position is very low. So the creditor should not give further loan or further amount to you. So it's very minimum, average payment period is good for you. Next one is working capital ratio. Working capital turnover ratio is expresses the relationship between cost of goods sold or sales divided by net working capital. Working capital turnover ratio indicates the velocity of the utilization of the net working capital. Net working capital means current assets minus current liabilities. So it indicates the number of times the working capital is turned over in the course of a year. The ratio measures the efficiency with which the working capital is being used by the firm. Next one is fixed assets turnover ratio. It studies the relationship between cost of goods sold or sales divided by fixed assets. Already we had calculated cost of goods sold, opening stock, add purchase, less closing stock, then add direct material, direct labor, direct expenses, or sales minus GP. Okay, that is the cost of goods sold, or sales is also taken it up. And fixed assets means only land and building, plant and machinery, patent, copyright, like that. Okay, then next one is total assets turnover ratio. It is also called it as turnover to total assets. It studies the relationship between total assets and net sales. Total assets means both current assets plus fixed assets. Okay, then net sales means already we have to calculate net sales, that is sales minus sales return is called it as net sales. Then next ratio is capital turnover ratio. Capital turnover ratio, it studies the relationship between cost of goods sold or sales and the capital employed. The ratio is calculated to measure the efficiency or effectiveness of the firm to utilize the resources according to the capital. A capital invested in a business to make sales and earn profit. So the ratio is good indicator of the overall profitability of the concern. Next we have to go for the classification on the basis of profitability ratios. So in order to study the profitability portion of the business, GP ratio, NP ratio, OP ratio, this ratio is useful to you. So first one is gross profit ratio. It indicates the relationship between gross profit and net sales. So it is expressed as a percentage. So it is multiplied by 100. So GP ratio is equal to gross profit by net sales into 100. Gross profit means sales minus cost of goods sold. Then the second one is operating ratio. Operating ratio establishes the relationship between cost of goods sold and other operating expenses and net sales. It is also take it as a percentage, so we have to convert it into 100 as a percentage. So operating ratio, cost of goods sold plus operating expenses divided by net sales into 100. Operating profit ratio, it is the differ from the operating ratio. Operating profit ratio studies the relationship between operating profit and sales. Operating profit and sales. Operating profit means net profit plus non-operating income, net profit plus non-operating expenses minus non-operating income, or 100 minus operating ratio, that's the operating profit divided by sales. Otherwise you have to calculate operating profit from sales minus cost of goods sold plus administrative expenses plus selling and distribution expenses, that is sales, the cost of goods sold, administrative expenses, office and administration expenses, selling and distribution expenses. So these expenses are deducted from the sales, we have to get the operating profit. That operating profit is studied for calculating the operating profit ratio. Then next one is expense ratio. It indicates the relationship of various expenses to net sales. Lower the ratio, the greater the profitability, and higher the ratio, less profitability. So lower the ratio, expense ratio is lower, your profitability portion is good. So the first expense ratio is cost of goods sold ratio. It expresses the relationship between cost of goods sold and sales. So cost of goods sold divided by sales into 100. Then office and administrative expenses ratio, here we have to take it as office and administration expenses only and divided by sales into 100. Selling and distribution expenses ratio means we have to only take it up selling and distribution expenses like bad apps, discount, like that, divided by sales into 100. Next, net profit ratio. Net profit ratio means studies the relationship between net profit after tax, that is profit after payment of tax is to be considered. Net profit before interest and tax you have not considered, okay. So net profit after tax divided by net sales into 100. Next classification is overall profitability ratio. The following are the important over profitability ratios, that is return on shareholders investment. It is also called it as net worth. So return on shareholders fund or shareholders investment, we have to take it net profit after interest and tax divided by proprietors fund into 100. Net profit after interest and tax means after the payment of interest and taxes we got a net profit, okay. Then proprietors fund means equity share capital, reserves and surplus, and preference share capital minus accumulated loss if any occurred. Interpretation of ROI, that is return on investment. The ratio is one of the most important ratio. So it is greater importance to the present and prospective shareholders as well as the management of the company. So it's higher the ratio, better the result. Higher return on investment is higher, your position is good. Then next ratio is return on equity capital. It studies the relationship between net profit after tax and preference dividend divided by equity capital into 100. That is after the payment of preference shareholders as a dividend, you have to deduct from the net profit. That is to be take it as return on equity capital, okay. Then the next ratio is return on capital employed. In a return on capital employed, here we have to take it as two, that is one is gross capital employed and another one is net capital employed. So first, what do you mean by gross capital employed? That is fixed assets plus current assets is nothing but total assets. So all the total assets are coming under gross capital employed, but net capital employed means total assets minus current liabilities, that's the net capital employed. So return on gross capital employed, how do you calculate means it studies the relationship between adjusted net profit divided by gross capital employed, and as well as it is expressed as a percentage, so multiplied by 100. Then return on net capital employed, it studies the relationship between adjusted net profit divided by net capital employed into 100. Then next classification is market test or valuation ratios. First one is dividend yield ratio. Shareholders are the real owners of the company, so they are interested in a real sense of the earnings distributed and paid as a dividend. So dividend yield ratio, how would you calculate dividend yield ratio? Dividend per share divided by market value per share. So how would you calculate dividend per share? Dividend paid to shareholders divided by number of shares. Then dividend payout ratio, or simply call it as payout ratio. It is calculated to find the extent to which earnings per share have been retained in the businesses. It is an important ratio because pluffing back of profits enables a company to grow and pay more dividend in future. How would you calculate dividend payout ratio? As usual, dividend per equity share divided by earnings per share. Okay. Then next, so how would you calculate earnings per share? Next doubt is, how would you calculate earning per share? Earning per share is nothing but net profit after tax minus preference dividend. That is, you have to pay dividend to the preference shareholders. So you have to deduct from that divided by number of equity shareholder, we have to get the earnings per share. That is, equity shareholder, how much amount they get from their business. That is called it as earnings per share. So dividend payout ratio is dividend per equity share divided by earnings per share. Then price earning ratio. It studies the ratio between the market price per equity share and earnings per share. It is widely used by the investors to decide whether or not to buy shares of a particular company. So it is very essential. So price earning ratio is equal to market price per equity share divided by earnings per share. Then earnings yield ratio, earnings per share divided by market price per share, and it is expressed as a percentage, so it multiplied by 100. Then already we had calculated earning per share. Next, book value per share means equity shareholders fund divided by number of equity shares. So these are all the classification of ratios. Next, we have to identify the differences between cost accounting and management accounting. So what are all the differences between cost accounting and management accounting? So the main object of difference is, first one is object. So in cost accounting, record the cost of producing a product or service only, but in a management accounting we have to provide all information to the management for planning and control through the preparation of budgets as well as standard costing. Then the next basic difference is scope. On the basis of scope we have to differentiate. So in cost accounting only we have to ascertain the cost, but in management accounting it's a wide concept, that is financial accounting, cost accounting, budgeting, tax planning, reporting to the management, and implementation purposes we have to consider the suggestions and interpretations given by the auditors, like that. Okay, so it is very important. Then nature. So how is it differ from the nature used for in cost accounting? Both past and present figures noted, but in a management accounting is concerned with the projection of figures on future only. And data used in cost accounting only quantitative aspects only used, but in management accounting both qualitative and quantitative data used, because you have to give a comment whether we have to make or buy decision or whether we have to accept the foreign product or not. So it's both qualitative and quantitative data used. Then development basis, how it's differentiated. In development aspect, cost accounting, industrial revolution, it's covered not only cost structure but also for planning and decision making. But in management accounting it has been developed only in the last 30 years only, so it is not developed thoroughly. Then principles followed. In cost accounting, uniform procedures followed for recording the cost and ascertaining of cost for different products on a different period of time for each product as well as services. But in management accounting no specific rules and procedures followed in reporting and management accounting. So from these From this slide, we had discussed about what do you mean by costing, cost accounting, what are all the limitations in cost accounting, what are all the advantages of cost accounting, why we have to go for management accounting, what are all the importance of management accounting, what are all the applications in management accounting tools like financial statement tools, comparative income statement, comparative balance sheet, what do you mean by trend ratio, what do you mean by trend percentage, then ratio analysis, how would you calculate liquidity ratio, absolute liquid ratio, solvency ratio, that is debt equity ratio, then dividend payout ratio. So in this slide we had in this video we had discussed thoroughly. So thank you one and all.